My colleague Hiral spoke to Rajesh Sharma, who's the MD of Capri Global, on the quarter by, and I'm guessing the conversation would have revolved a lot around one, what is the trajectory of asset quality and the margins in light of the fact that interest rates are coming off and more. So I think herein to a small slice of that conversation with Capri Global.
My question to you is, one, strong growth in the second quarter, but you still maintained your guidance for FY26 across parameters. Is there any upside risk or a downside risk that you are incorporating that you've maintained a guidance? The only reason I ask is because with such a strong growth, there is a possibility you could overshoot.
Yeah, thank you. I think you are very valid and genuine question in terms of when you are growing fast. But if you look at, there's a diversification of product. Plus, we are only in a collateralized secured segment, be it gold, be it MSME, micro lab, or construction finance, which are collateralized by property, and gold is collateralized by the gold. So the growth is coming on the back of expansion of branches, investment in the technology and data science capabilities. And of course, the India is also growing. If we expect the Indian economy to become third largest economy, and we are going from 4 trillion to 7-8 trillion in next 8-10 years, then this retail segment will expand equally, and that offers a tremendous opportunities for companies, many companies like us, who are in a segment where banks do not lend those customers who don't have adequate income proof document, but they generate positive cash flow. So I feel at the 25,000 crore base, we still have a great opportunity to grow at a pace of 30 to 40% year after year. And having a collateral base, having invested in the compliance, invested internally in the assurance function of internal audit, I think we are well positioned. Our risk levers are in place to do the check, and we are well positioned to achieve this growth.
Okay, so with all of this said and done, if you have to look at the return on assets and on the return on equity as well, for the primary business segments, gold loans, affordable housing, MSME, construction finance, which segments are going to be the biggest drivers of the ROA expansion in the coming quarters?
So I think ROA we delivered this time in the 4, and we believe this is a very good ROA. Cost income ratio will come further down. We are working to reduce our cost of funds, and with mix of that, I think we are poised to deliver a ROE between 16 to 18%. The fee income is also giving good support. This quarter, if you look at, we generated a fee income of about 203 crore rupees, 29% of total income. So there is a huge focus to do cross-sell, build a very high-quality fee income vertical, which we did. Insurance distribution, car loan, and co-lending. Almost 21% portfolio is sitting in the co-lending, which is highly capital efficient.
You mentioned about the cost to income ratio. Now, given the ongoing branch expansion, and if you talk about the technology investments, how sustainable is the current trend, and what is the long-term target that you have to the cost to income ratio?
So currently, cost to income ratio is about 49%. Long-term target, it should be around 40%. But gradually it will come. It will take another 1.5 years time. If you see from the time 2 years ago, it was 70%. Now it is 49%. And 4% ROA. I think the biggest lever next 12 months will come from the reduction in the cost of fund spread. And that will also help us to deliver the better ROE.
Okay, got it. Apart from that, if you have to talk about the net interest margins as well, now when you talk about NBFCs, some bit of an increase that's happening in the cost of funds, but what is your outlook for the net interest margins for the second half of the year?
So I think if you talk about the net interest margin, or from better perspective, let us say about the spread, our spread is likely to expand another 25 basis on the back of reduction of cost of fund, and also our cost income ratio coming down. So our margins are going to be better than what it is today.
Okay. Let's move on to the other aspect in terms of your co-lending strategy. Now, your co-lending book has also grown significantly. What is the current mix of partners and what is the strategic limit or the target for co-lending as a percentage of your total AUM?
So I think co-lending is regulated by Reserve Bank. It has an advantage of low cost fund of the bank and the collection efficiency and low cost origination and underwriting capability of NBFC. So I think it is benefiting the customer. It is benefiting the banks to book the priority sector loan and having exposure on the retail customer rather than having exposure on the NBFC. So it's a very good um, thought and concept promoted by Reserve Bank, and now banks are now guidelines is also now unified and clarified. So we will keep a co-lending AUM in the range of about 20% plus minus 2-3% here and there, and if you can maintain that, it is a highly capital efficient. We need not to provide any capital. At the same time, we are able to collect our margins and able to deploy branches to the most efficient manner. So I think it is going to stay here. The new guidelines are going to be in place from 1st of January. Within that quarter, we see some uh, uh, rollover will happen from old guideline to the new guideline, but that should not come in the way to reduce. All banks are working towards
Got it.
aligning towards technology and other aspects.